Hello and welcome to episode 364 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leaks. Damien, welcome back. How are you doing?
I'm good, Andy. Like you, I think we're both almost exhausted. It's been a hard push into the end of the tax year. We had a lot going on at Money to the Masses with the stuff we were doing on socials, with Grow It, for example. But tax year end is always really busy for anybody who works in finance. And we did a piece on the podcast about tax year end. Tax year end happened this year. There's a feeling of a sort of almost a sigh of relief after the tax year end passes, but at the start there's a little bit of a flurry of activity too. So the reason that I mention that as well is that listeners should definitely enjoy this week's episode, because there won't be an episode next week of the Money to the Masses podcast, because Andy and I are going to have a week off separately, not together, but we're having time off over the Easter period with our family. So there won't be a show, but we will be back as normal after the Easter break.
Yeah, that's it. It does feel like it's been a hard slog and we deserve a break. Actually, you saying we're not going away together, maybe that's one for the future. Maybe we could do it. We could take Money to the Masses on the road, do a couple of podcasts while we're on holiday, bring the family.
Yeah, we should do. We laugh about it. We have talked about doing a mini tour almost to go and record in different locations and just see people from different parts of the UK. One thing I am now conscious of is that with the opening up of the economy and obviously living with COVID, that it really does open up now the possibility of doing a podcast meetup. I've always been reticent to organise one because obviously what with COVID and the pandemic, different people would feel differently about going to a public space. But now that we're being told to get on with our lives, then I am thinking of putting out there a possible meetup in the next couple of months. So if you are interested, then do send in tweets right on our socials or in the Facebook group that you're interested, because that will motivate us to do a meetup. And I'm thinking probably maybe June time.
Yeah, and if you've got suggestions of where we can meet up as well, we'll take all suggestions on board. So I suppose we should get on with the podcast then. What is it we've got coming up this week?
So the three pieces this week consist of an investment piece. I want to talk about something called averaging down, and in comparison really with something called pound cost averaging that we've covered in the past on the podcast. But averaging down is something slightly different, and people need to understand what it is and perhaps the slight danger in pursuing that kind of strategy. So that's the investment piece. I also want to talk about tax-free childcare. Way back, I think it was about 5 years ago, we touched upon this scheme being launched. It was really a scheme that was going to replace childcare vouchers. And with the cost of living crisis that's happening, we're becoming very aware at Money to the Masses that there's a demand for content that is going to help people maximize their money. And this is a scheme that lots of people don't know it exists and that they can benefit from. So I'm going to explain that. And the final piece comes from a question, really. I've been asked a number of times what's the difference between financial advice, financial coaching, and financial planners. So what is the difference between those different things? I think there is a bit of confusion out there. And given that people are going to probably be engaging with these services, it's probably useful just to define what they are.
Okay, so let's start with averaging down then. What is it and why do you need to be careful?
Well, averaging down is a strategy when it comes to investing. And it's not something that is particularly dangerous as such, but it's something that people need to understand how it works. So quite simply, averaging down is when you buy on the dip. So let's say you're investing in the shares of a company, the share price falls, and then you decide that you want to buy more of those shares at that cheaper price. So just to give extreme examples, I always like to give extreme examples because it helps people understand. If you were going to buy one share in a company worth £10 and the share price subsequently fell, your share is now worth £5. You paid £10 for it. So you're sitting on a loss of £5 on that share. But you decide that you think this company is great. So you buy another share in that company for £5, which is the current price. Now, if you think about it, you've got two shares in that company now, and the average price that you bought them at is £7.50. So the idea is that as the share price falls, what you're doing by keep buying more of that particular company on the way down is that you are bringing down the average price that you've paid for a share. Now, the theory is that then when they start to rebound and the share price pushes back higher again, then you will make money, and effectively more money, because you've bought shares at a lower price. And let's say the share price goes way back above the £10 level that I mentioned, then you'd be quite happy that you bought more and more of these shares based on your conviction. Now, one thing you've got to stress is that people talk about this averaging down. You haven't actually got rid of a loss in the example that I talked about. So even though your average purchase price was £7.50 for the 2 shares, because you obviously add the £10 plus the £5 you bought the second share at, divide that by 2. I am teaching people to do averages here, but that's how you get to the £7.50. Now, you are still sitting on a loss of £5 on the first shares. You haven't got rid of that. But the point is that it can be profitable if the investment or the share rises, in my example. But the danger is that it can compound losses as well. And that's because when a share falls in value, it doesn't just mean that the company is now available at a cheaper, more bargain price. It could potentially be a warning sign. So it could be the share price is falling because there is fundamentally something wrong with that company, and the share price could keep going lower and lower. So if you keep following that averaging down strategy and the share price doesn't rebound, then you're going to be compounding your losses. So the averaging down idea works if the market has overreacted to maybe a piece of news about the company or something that's going on, and you feel there is no fundamental reason that the share price should have fallen because the fundamentals of the company are still incredibly sound. And that is where the difficulty lies, because you've got to be the judge of that. And so you've got to be able to make that call that the fall in value is an opportunity rather than a potential trap. But a lot of people do start to average down when they invest, and it's something you can get sucked into, because what you start doing is you start chasing your losses. And one of the biases, we've done biases on previous podcasts, we talk about a number of them that we have as investors, and one of them is this consistency bias that we tend to have. And we have to be consistent in our views, and it helps in society that we do maintain consistent views, because it helps us understand what's going on and us to work as a cohesive group, because things are a bit more predictable when you have relationships. The trouble is that as an investor, what that means is if you say company X is amazing and no one understands the fundamentals, but I do, as the share price starts falling, you just need to go on social media and you see this happen over and over again. People will just keep saying you've got it wrong, and they'll argue because they've pinned their colours to the mast and they won't change their viewpoint. It's a bias that us humans have that we have difficulty with, and that's not just in investing, that's in all areas of your life. Once somebody has a view, they very rarely or find it very difficult to change that view, particularly if the new view has got to be the opposite to what you had before. And so what people will do is they'll keep chasing it lower and lower and lower and lower, and at some point they either lose all their money or they're going to have to admit they were wrong. And admitting they're wrong is far more difficult. And it can be a dangerous strategy if, over the long term, the price of the asset or share, for example, doesn't rise, and you need it to make that averaging down work. Now, people listening to this might go, well, Damien, how does this differ to pound cost averaging, something that I've talked about before on the podcast? And just to reiterate what that is, let's say you wanted to invest in the market right now and you decided you were going to perhaps buy a S&P 500 tracker, for example, or whatever the investment was, and then you decided to, rather than put all your money in at once at the start, this is particularly useful if you are worried the market is going to collapse, that you could instead drip your money into the market in regular amounts over a regular interval, like time period. So let's say you're going to put £1,000 in, you might do £100 a month for 10 months rather than just £1,000 up front. So if the market collapsed, then what would happen is as the market's falling each month, you get to buy more units or more shares in that tracker, whatever it is. And so when the market eventually rebounds, you therefore benefit because you will profit from buying these things at a lower price on the way down. Now that might sound very similar to averaging down. There is a fundamental difference though. Well, there really are two fundamental differences which I want people to understand. Pound cost averaging, you buy at regular intervals, and it's a strategy that people might use to mitigate a potential market crash. Of course, if the market rallied straight away, then you would have been better off putting all your money up front. So pound cost averaging, you won't be as profitable using that strategy than if you just put all your money up front if the market just just exploded higher relentlessly. But averaging down, you buy the dips. So you only put money to work when the market falls. So with the pound cost averaging strategy, you're putting in money regularly to mitigate movements in the market. You're just worried that what will happen. So you just think, do you know what I'm going to do? I'm not going to try and time the market. I'm going to just put money in at regular intervals. And that way it helps to mitigate the issue of the market suddenly collapsing that you invested right at the start of a bear market, for example. But the other thing that's different is that when people use pound cost averaging, they typically will use it in an investment like I mentioned, perhaps like an S&P 500 tracker, something that probably is broadly a passive investment that tracks the market. Now, if you go and look at any stock market chart over the long term, you go back, stock markets generally go higher over time. And in fact, I don't know why I even say generally, just look at the S&P 500, the FTSE 100, whichever stock market you want, and you go back 10, 20, 30, 40, 50 years, the longer your time frame, you will notice that the trend is up. Over a short time frame, 5 years, even going to 10 years, the market can fall. But if you go over a very long time frame, the market goes up. And that, I would say, if you're going to use an averaging down strategy, then averaging down, but buying something like a tracker, like you're buying the market essentially, that you know will go up over time, can work, because it's not like you're buying into Tesco, for example, or another company where the share price could collapse or something could go wrong and you don't know if it's going to recover. You're not going to be exposed to one company and the inherent problems that that company could have. It could potentially collapse. So the message of this part of the podcast is be aware that if you're investing and the market dips or the investment you're holding dips, ask yourself, why are you buying more of it? Is it because it's based on fundamentals that you really understand what you're buying and it's going to go up over the long term? That's a very difficult thing to judge. Or is it because you're buying into something that is perhaps something like a passive investment and you're holding for the long term? Because these strategies work for the long term, that then it can be a profitable strategy. You're buying a stock market tracker, for example. And the other time where using a averaging down strategy can work is if you start to favor blue chip companies. So if you are buying shares, for example, and you buy into blue chip companies, and by that I mean very established companies, often with market caps in the billions of dollars. They're well-known household names and they provide regular dividends. So to be honest with you, they are fairly boring companies to a certain extent. Think of companies like Coca-Cola. That is something where you might get people like Warren Buffett, for example, would buy more of something when the market starts to fall because he likes the fundamentals. The averaging down is him taking more of an opportunity that he understand. And so one final point I just want to add on the averaging down: if you use it as a strategy, be aware that you are, but if you continue down that road, there can come a point where you're increasing your exposure in your portfolio to a particular investment, or let's say a particular share in a company. So you're actually raising the risk in your portfolio, and particularly the exposure to that one company's fortunes. You're making an increasingly bigger and bigger bet that if it went sour, could hit your wealth. So make sure you understand averaging down, the pros and cons I've stated, and how it is different to pound cost averaging.
Okay, moving on to tax-free childcare then. You mentioned at the start of the podcast, we covered this 5 years ago when this new system came in that kind of replaced the old system of childcare vouchers. You're going to explain a bit about it and why people should be doing it if they're not taking advantage of it.
Yeah, so I think it was about 5 years ago. I found the podcast episode, and I always go back and listen to the shows. And we were talking about this new scheme that was coming in, and the details were a little bit sketchy at that point. And we explained how it would work and who it would benefit, etc. But now we're further down the line, and with the cost of living crisis, there are lots of things and tax breaks that people need to be made aware of that they can take advantage of. And one way of cutting costs is to take advantage of things like the tax-free childcare scheme. And what it does is effectively reduce the cost of childcare for you. And to give you the highlights, working parents can get up to £2,000 a year to pay for regulated childcare, but that also includes holiday clubs and out-of-school activities in holidays. So while we're making this podcast now, it's the Easter holiday coming up. Theoretically, it could be used for activities during Easter holiday, but it can be any holiday. Now, the tax-free childcare scheme gives eligible working families up to £500 every 3 months, so that works out to be £2,000 a year, or £1,000 every 3 months if the child has a disability, which goes towards the cost of holiday clubs, the before and after school clubs, childminders, nurseries and other approved childcare schemes. And the way it works is that for every £8 that you put into a tax-free childcare account, the government tops it up with £2. And that money in total can be used towards the cost of childcare that I mentioned. Now, it's available for children up to age 11 or up to age 17 if your child has a disability. And the reason I really wanted to bring it to people's attention, because research has shown at the moment about 328,000 families use tax-free childcare, but it's estimated that around 1.3 million families could actually benefit from it, which means that's about 1 million families that aren't currently taking advantage of the scheme. Now, I'll come on to the eligibility part in a second and run through that. We will put a link in the show notes of the podcast and also on the website in the relevant article that relates to this particular podcast show. But the tax-free childcare is on top of the 30 hours free childcare that everybody gets for children aged between 3 and 4. But what's also good is that grandparents can, for example, pay into the scheme as well. So it isn't just that parents can pay in, grandparents can pay into a tax-free childcare account. And also it is open to people who are self-employed as well. This isn't just for people who are employed. And if you go back and remember the childcare voucher schemes that I took advantage of back in the day when my daughter was younger, it was a little bit more convoluted in terms of what happened at the end when you had vouchers that were kind of stuck in the system. With the tax-free childcare online account, if it gets to the point that you want to take the money out, you can do. You will lose, obviously, the government top-up. That will be taken back, but you can, in fact, take money back out of it if you don't want to use the account anymore and it be closed. Now, I'm going to run through the eligibility very quickly just to give you the highlights. Now, it's based upon whether you are working, your income and your partner's income and your child's age and circumstances, as well as your immigration status. Now, you can get the tax-free childcare if you are working. You can even get it if you are on sick leave or annual leave, or if you are on maternity leave or shared parental leave. Now, there are, again, always nuances to these things, which I will link to. Now, if you aren't working, then you may still be eligible if your partner is working and you get incapacity benefit, severe disability allowance, carer's allowance, or contribution-based employment and support allowance. In terms of income, then again, there are certain rules. You need to earn a certain amount over the coming 3 months, and that's got to be at least the national minimum wage or living wage for 16 hours a week on average. So that means over a 3-month period, that equates to £1,976. If you have a partner, they'll need to earn at least that much too. If you're self-employed, you are still eligible. And if you think you're not going to make enough profit over the next 3 months, you can use an average of how much you expect to make over the current tax year. But again, there are slight nuances if you, for example, have started a business recently. But if you have an adjusted net income, which is your taxable income before any personal allowances and minusing things like gift aid, if that is over £100,000, which won't be many people, then you are not eligible. And in terms of immigration status, then I'm not going to go through all of them, but basically you have to have British or Irish citizenship as a default. But there are, again, other nuances as well. Like I said, I'm going to link through so people can see how it interacts with different things like certain benefits, because you need to check if you'd be better off when you use these things. For example, tax credits can stop if you successfully apply for tax-free childcare, and you will also have to cancel universal credit and childcare vouchers if you're using that scheme. So you can apply online to take advantage of tax-free childcare. Again, we'll link through to the page and you can see the eligibility criteria, and then you can start to take advantage of the scheme. Obviously, if you're going to use the scheme to pay for anything, then the childcare that you use will have to be registered with the scheme in order for you to pay them. But the takeaway from this piece of the podcast, Andy, is that there's help out there for people, and lots of people aren't taking advantage of things like this scheme that theoretically can make their childcare cheaper.
Okay, so let's move on to the final piece of the podcast, Damien. You're going to clear a few things up in regard to financial advice financial planning, and also financial coaching. There's a difference between those three phrases, isn't there?
Yeah, and one of the problems in the finance world is the introduction of jargon and terminology, which often is for the benefit of making the company or the service seem better or more impressive. And it's something that just adds to the confusion out there for consumers. And sometimes I think leads them to not want to engage with financial services full stop. Now, when we do reviews of different investment services out there, so it could be an investment platform, it could be one of the robo-advice propositions, we look at what they do and the services you get, and they're constantly evolving. And some of them now are trying to differentiate what they do beyond just you pick a portfolio that's execution only, as in you take all the responsibility yourself, to providing regulated advice by recommending a portfolio. Some of them are starting to offer access to financial planners or advisors, but what they're doing is technically not regulated because they're coaching. All of these things are slightly confusing. So what I want to do is just run through what the difference is. Now, let's just start with financial coaching. What that does is provide education and guidance to help people make financial decisions. And a coach should understand all the options that are available to the customer, for example. And it's aimed at people who don't necessarily have complex finances or who have relatively straightforward needs. And what we're getting with financial coaches is they might have, for example, one-to-one meetings. It could be online with somebody, and they will often be paid for their time. And it could be one session, it could be a number of sessions where they will start to talk through what their options are and what they're trying to achieve. So basically, it's a form of best practice guidance. Now, there are quite a few advisors who have decided to go down that route, because one of the things with coaching is it's not regulated. So there is no regulation going on in that arena. So from a coach's point of view, that is obviously a positive, because there's a lot of work in regards to regulation and reporting. But it's also important that people understand that a financial coach cannot make personal recommendations as to which investments or financial products are suitable for you. That is what an advisor effectively does. And so what a coach might do is they might meet with you, chat with you, and they'll help you build a plan, and they'll help you improve your knowledge in certain areas. So it's probably moving a bit towards having a personal trainer of some kind. So they're helping you to get fit in a way, but financially. So that can be beneficial for a lot of customers. But what they need to understand is where the lines are. So these people aren't giving you regulated advice on what they can and can't do. Now, some of the online propositions out there, robo-advice propositions included, are starting to offer this coaching alongside their investment propositions. And the reason they do that is obviously they want to help their customers, but it's good for them to help people make decisions because it keeps them as loyal customers and helps them go through the decision trees effectively to purchase products. So I'm not going to go and list some of the people out there, but what you will notice is some of the platforms are starting to launch this coaching aspect to their service. It's not regulated advice. You're going through as a DIY investor, do it yourself, picking the investments you want, but they're just giving you the helping hand in the background, just helping you navigate it. Now, that is obviously very different to financial advice. With a financial advisor, what you're doing is you will meet a financial advisor and they will recommend what you should do. So they are regulated by the Financial Conduct Authority, and they will give you personalized advice on how to manage your money, but more importantly, which products to buy and which are best suited to you and your objectives. Now, if you engage with a financial advisor, then you should check that they're authorized, and you can find that out on the FCA's Financial Services Register, and you want to make sure there's no warnings on there or anything. But financial advisors can vary in the breadth of service that they provide you. Now, this is where I think it gets a little bit confusing when you talk about a financial advisor and a financial planner. Personally, I wouldn't say there's much of a distinction between the two. I would expect a financial advisor to provide the service of a financial planner as well, which I will come on to in a second. Now, a financial advisor will make a recommendation of the products, and it means because they're regulated that you have a comeback. You are protected by regulation. And so there was obviously the FSCS, the Financial Services Compensation Scheme. You have to remember that if they recommend an investment product, you're not protected against the eventuality that the market might slump and you lose money, but you're protected against whether it was badly advised, so it was the wrong product you were recommended. So there can be some comeback on that and some compensation. Now, you are obviously going to have to pay for this service as well. I've touched upon how much advisors cost, but it's worth me just reiterating it today if anybody's thinking about engaging with a financial advisor, because Unbiased, who are one of the directories of financial advisors, so it helps you find financial advisors, a bit like Vouched For, they have done analysis on the typical cost of a financial advisor. Now, they can charge in different ways. They can do a fixed fee, so it's a one-off amount that they charge. They can do a percentage of assets, so they charge you a percentage of your portfolio, or they can do an hourly rate, which in the UK can be around about £150 per hour. So if we look at the ongoing fees, they tend to be about 0.25% a year to 1% a year. And they can charge an upfront fee as well. It can be as much as 3%. That's expensive. I wouldn't pay that personally. But if they start to do individual fixed fees, then if you want to, say, have advice on investing £10,000 and setting up an ISA, that will cost you about £300. If you wanted advice on pension contributions, what to do with them, and you're paying around about £300 a month, they might charge you £500. If you are wanting retirement advice on a £250,000 pension pot, they'd probably charge you around £3,000 on average. And if it's about consolidating pension pots and the pension pot is worth about £500,000, then you are likely to pay something in the region of £5,000. And those fees are meant to be reflective of the service you get, the advice that you need, how long it will take, and also, as you could tell when I read through that, the size of the assets involved. And they broadly look at between 1% and 2% of the assets in question. So the thing to bear in mind is to have a conversation with your advisor, because they can be flexible with how they charge, and you will know that up front when you have that conversation with them. But they give you some ballpark figures. Now, when it comes to financial planning, it's interesting because Unbiased and Vouched For do not distinguish between financial advisors and financial planners. So a financial advisor, as I said, will look at typically your circumstances, and they will look at, say you've got money to invest, and they'll focus on what to do with that money. They'll recommend a product, maybe like a pension or an ISA, and they can be a bit more transactional. But a financial planner, and I say this from a point of view that when you look at what a financial planner says that they do, because there are companies out there that define themselves as financial planners rather than financial advisors, they say they would look at what you want to achieve in life. So they'll be much more goal and life focused. They'll do a financial roadmap of some kind, how you're going to achieve that. They might engage other people in your life as well to build this whole holistic plan. They have an ongoing relationship with you, which obviously there's charged a fee. So they will typically help you identify some of those goals and how you achieve them. They will normally include long-term cash flow models and forecasts. They will include things in a financial plan that they recommend, such as funding for retirement, tax efficiency, insurances. So once again, these are regulated, but they are meant to be providing that more holistic service. And when I've looked at what people who say they're financial planners do, their fees are that much more expensive, it seems. But I've seen things quoted around £2,000 to £4,000 for them to build a plan for you. Now, I've worked in industry before, and people who would be classed as financial advisors, and they did all of that planning side of things. So the message really is that financial coaching can be useful, and it is starting to be provided by a lot of the direct-to-consumer services out there as an additional free benefit. But they also allow you then to go and move on if you want advice. So you could speak to a financial advisor in the background. Again, that's regulated. Some of these propositions are also doing a fixed fee model where you can just pay for advice on one particular area, typically on investments. But if you want to go and see a financial advisor, they can look at your broader plans. It will cost you more, as I mentioned in the cost analysis. There are different ways to pay, but there's also financial planning, which can be a much more holistic, where you go not necessarily with a single problem you're trying to fix, but with somebody who's going to build a plan. But for me, I think those last two, financial advisors and financial planners, it's a bit more of a grayer area. But some financial advisors will just focus on a purely transactional relationship, whereas a financial planner would typically pride themselves on doing that much more holistic plan that includes all sorts of things like cash flow modeling. So make sure that you know what you're getting when you have these relationships. One other that I'll just throw in there, people might say, what's a wealth manager? Well, again, that's another term that typically it's in reference to people who might just do investments. So they might call themselves a digital online wealth manager, and that might be one of the robo-advice services where they literally just provide you with a portfolio of investments. So they may recommend that one thing because it's to do with investing. So wealth managers tend to focus on investments, but make sure you know what you're getting, and more importantly, whether it's regulated advice or not. And if you are getting coached, understand that they shouldn't be recommending you personalized investments or products, because if they do, then they are breaking the rules.
Okay, so that brings us to the end of the podcast, and just another quick reminder that we're going to have a break. So the next podcast after this one will be in 2 weeks' time. So if you want to get in touch with Damien in the meantime, you can do so. It's Damien at moneytothemasses.com. Twitter, it's at moneytothemasses with number 2. And again, you can always contact Money to the Masses through Instagram, TikTok. We've got lots of YouTube stuff as well. You know the places by now. And actually, a quick bit of homework for you while we're away. Make sure you review the podcast in the usual places. It really helps us out, and we'll read out some of those reviews when we come back. And so that's it, Damien. Until next time.
Until next time.